Let's have a closer look here at the energy sector, because there's been some huge moves. First off, read this disclaimer carefully, and do your good deed of the day by liking and subscribing. We are seeing broadly in the market rotations. That is the name of the game. There's been quite a few, sectors, subsectors, and themes that were, really overbought, big time. Others were, more depressed. So even though we had some major sell-offs, say yesterday, you do see that some themes had huge bullish moves, like fertilizers, cosmetics for some reason, economically sensitive, still doing okay, legacy media 4%, definitively some rotation happening. We will look at some leveraged ways to trade the energy business. And we have here this one, which is the ERX. It gives you 2 times bullish exposure. It is up 347-ish% from the 52-week low. Huge move, but still very far away from the highs. If you are feeling bearish, you have this one, which is the ERY. It is at 52-week lows and very far away from the highs. Okay, let's first... Okay, so we are going to look at the XLE, which is the benchmark, the ERX for the bulls, and the ERY for the bears. Let's look at the seasonality of the XLE. That's pretty relevant to look at. And we want to get, a bunch of years. So 20 years. So February is one of the stronger months, but you can see here that March and April they lean bullish, but we don't have any really strong percentages. Even if so let's change it to the last 10 years. Yeah, it doesn't improve the situation much. And I prefer to look at 20 years because then we also get some bear markets as part of the data. So here is the chart for the XLE. This is the big picture, all the data I get here. And something that is quite interesting is that we have had this very major move from the lows. That is obviously very good. It's been very good for the bulls. But looking here at the weekly RSI, we have reached a territory that has produced problems in the past. So that's just something we have to accept. If we zoom in a bit, we have broken through this blue 100-week moving average. That is a bullish sign. Definitely strength there. So there is a bit of a mixed message so far. If you look here at the correlation, we do actually have a -54 negative with the S&P 500 long term. Looking here at these daily data points, and let's zoom way out, because then something interesting, pops out. So here you can see the PPO. It measures the distance between the red 200-day moving average and price. And you can see that the current distance is, you see this purple line. Being this far away usually triggers or forewarns a pullback. That is the fact, and these are many years. We see that we usually do not stray that far away before there is a meaningful pullback. Even here after the financial crisis, the bulls were more modest. So there is definitely some euphoria currently. Let's do some measurements of some prior big rallies, like this one. To this high, a rather impressive bull rally. Let's also measure, this is being generous, but if we do measure it like that, a bit controversial, but let's do it. And then we measure this recent rally from the lows, like this to there. Okay, so here we have 104% within 343 days, 88%, 70%. Yeah, I mean, the current rally has been rather aggressive. When you combine that with a very stretched PPO and the RSI, that historically doesn't work out. If you look at some of the look at these prior times where we have gone up there, usually it triggers pullbacks. That is just the fact. You can also see with this black line that we are going to test some very key long-term horizontal resistance levels as well. Hence, from a purely like strategic standpoint, if I was, the official advisor to the bulls, I would say it probably is a good idea to maybe, before even attempting to try those long-term key levels, and given that we are very overbought, maybe cool it down a bit, maybe correct, and then attempt to break out later, because there's just been so much too fast. Yeah, but let's explore further before we draw any conclusions. Here you can see it, Finwiz. We have broken out above this channel. Obviously that is bullish, but then again it ties into this theme that is emerging of excess. It's everything in moderation, and given that we have seen these major rotations in other sectors, it's a bit of a lesson that if you go too far too fast, then the correction becomes that much more aggressive. So here we have the S&P 500, which is the ultimate benchmark, and I have looked now at the difference in price earnings between the energy sector and the S&P 500. And the energy sector is actually now, due to the very aggressive rally from the lows, a whopping 11% above the S&P 500. The dividend is still much better for energy, so you have 1.46% here for the S&P 500 and 4.61% for energy. But the dividend was way better back towards the lows. And that is because the dividend yield moves inverse with price. Okay, so let's now look at the correlation here between the energy ETF and the leveraged ways to trade. Okay, so first we look here at the weekly data points. And you do have the ERX if you are feeling bullish. Here we have a 96% positive correlation. That is pretty good. Looking here at the daily data points, almost 100% correlation. That is really, really good stuff. So the bullish energy leveraged ETF, it does a pretty good job of tracking the underlying index. So here's the bearish one, the energy bear. Here we have a minus 49%. So long term it has been problematic. Looking at the daily data points, then we have a 96% negative correlation, because we do want a negative correlation with the bear. So I would say that is decent. That is so for the shorter time frames, which is what they are intended for. They certainly seem to work pretty well. There's some tracking error, but it's brought down to a minimum. Okay, so the bulls are definitively still in control when it comes to energy. We've seen a very huge move, and yesterday we had a very big day. As you saw here, XLE, the energy ETF was up 3.46%. That's huge. But it's all about buying low and selling high. There's been a very big move from the lows. We went from being very oversold to now having a higher PE than the S&P 500. The PPO, all the technical levels are basically screaming excess. Hence, the probability of some correction is pretty high. So even though bulls, yes, they are still in control, I think it makes more sense to look for some temporary bearish opportunities for the energies than bullish at this point. Because if you are going to be a bull right here and right now, then you are pretty late here to the party, as these percentages show. As far as the future price for crude oil and other fossil fuels, in order to compete with the decreasing prices of the cleaner energies, the price needs to go down. That's it. That is how they can compete, and that is another thing to consider. But the XLE, it is an energy ETF. It is not an oil and gas ETF, even though it is currently completely dominated by oil and gas companies.